Okay, we are back. I'm very happy to have on the Goldstein on Gelt show award-winning author John Wasik, who has recently come out with a book called Keynes' Way to Wealth, Timeless Investment Lessons from the Great Economist. John, a real pleasure to have you.
Thanks for having me, Doug.
Now, Keynes is best known for his economic theories, and specifically he talks about public spending, but he was also an investor. Tell us, was he a good investor?
Well, he was a great investor, and when I did this book, I discovered in the research that he was probably one of the best investors of the 20th century. He had a whole other life apart from being a world-famous economist. He was investing several portfolios, including two British insurance companies, his own money, his friend's money, and a special fund for King's College, Cambridge, which was his alma mater. So he was quite active in that sphere and a very, very powerful innovator.
So what sort of ideas did he have in investing?
Well, at the time he started, which was between World War I and World War II, he had introduced quite a bit of equity investing to modern institutional portfolios. At the time, the conservative way of doing this was saying, well, we have real estate and we have bonds, and that's it. So he introduced buying stocks, common stocks, preferred stocks into modern portfolios with the idea that, well, bonds never really increase in value because there's no growth component to them. Maybe you get lucky when interest rates go down and bond prices go up, but it's not something you can really count on. So he saw stocks as ways of not only producing income through dividends, but growth through capital appreciation. So that was a major step in his time.
On the one hand, on the other hand, he was also known as a critic of capitalism. So how do you explain the apparent contradiction?
Well, what happened was that Keynes had a front row seat to not only the end of World War I, which triggered a huge recession in Europe, but also the hyperinflation that led to the rise of Nazi Germany. He had warned about it in a famous book called Economic Consequences of the Peace, which kind of made him a global superstar on the economic front. And he basically said, look, if you do these things to Germany economically, it's going to cause some big problems, and he was right. But he also saw a lot of different things that weren't working in capitalism. He didn't think that markets were necessarily efficient. He saw things where people were rapidly speculating on different things, and there weren't any controls on certain types of behavior. So he saw all the good and bad things that were going on in the markets. Nevertheless, he was a professional investor, so he did believe in capitalism to some extent, but he saw ways in which it could be fixed.
And what sort of proposals would he be giving, let's say, to us today in order to deal with some of the current economic problems?
Well, he was a big believer in sort of fixing currencies. So at the end of World War II, actually when it was just concluding, he sat in on the Bretton Woods conferences, and he was kind of the godfather of that whole idea that, you know, if you could create sort of a level playing field for developed and developing countries economically, and he looked at fixing currency levels, then you would have less disparity between the wealth in countries and less reason for war. So out of that came out the International Monetary Fund, the World Bank, and a bunch of different mechanisms to help keep stability as part of the world economic order. Of course, Bretton Woods was part of it was thrown out in the early 70s, the currency part of it. So we have huge currency disparities, but they're probably not as bad, as if we had done nothing, it probably would have been much worse. So he attempted some big-scale moves there.
Okay, we're talking with John Wasik, who recently came out with a new book about Keynes called Keynes' Way to Wealth, Timeless Investment Lessons from the Great Economist. But you've perhaps seen him on Reuters, on NBC, NPR, all over the press talking about major economic issues. John, one of the issues that, in fact, Keynes really does talk about is the issue of government spending. And recently, Paul Krugman wrote a piece saying that in order to get out of the recession, America didn't spend enough. And yet lots of people are thinking that America is way, way too deep in debt. Can you give us sort of a Keynesian perspective on this?
Sure. And here's where Krugman's coming from. Keynes's basic theory, and this was developed during the height of the Depression, was that if you spent money to create jobs, then people who were employed would spend money and prop up the economy. Now, if you don't have demand in the economy, you have to somehow create it. How do you do that? Well, you have to make sure that, one, people are working, and two, people are saving money. When recessions and depressions come along, they're not spending money, and it creates this horrible dog chasing its tail sort of ugly economy where, you just don't have any demand for goods and services. So he said, well, look, let's put some money into government spending, create some jobs, get people spending, they pay taxes, and there's a virtuous cycle there. Krugman felt that not enough money was spent during the recession that followed the global financial collapse. And I think he's right in a lot of different ways. There could have been much more spending in terms of public infrastructure, especially in the United States. China did it. Europe did to a smaller degree, and had another crash of its own in the Eurozone. So, the Keynesians believe that you can do this for a while, and then you don't do it forever, but you do it as a stimulus. You kind of prime the pump. So that's kind of the operating principle. And there's always a big philosophical debate on whether government should ever get involved. Private sector will pick up the slack. Keynes discovered back in the 30s that the private sector just won't do it. It just doesn't happen. So that's why he evolved this theory.
Well, it also seems to add to the argument that the Europeans seemed more interested in using austerity as a way of dealing with the problem, and they still really haven't seen much growth, and there's certainly not been a lot of success in using the austerity model. So it lends credence to the Krugman suggestion.
Well, I sort of covered this in the epilogue of my book as I believe it was the World Bank did a study on all sorts of measures that were introducing austerity programs throughout the world over the past couple of decades, and none of them worked in stimulating the economies. So what Keynes had to say is that, well, this works. It proves that if you start creating jobs, it's going to help the economy, give it a short-term boost. Europe went in the opposite direction, and they're just barely clawing themselves out of a very nasty recession. Unemployment is still very high, and I think they are discovering that perhaps this is not a totally comprehensive solution to their problems.
So let's try to bring this down to the personal level. My day job is that I'm a financial advisor. I help people with their investments and their financial plans. And one of the things that I'll always tell people when their money situation isn't looking good is, well, you better start saving or earning more, and certainly not borrow to try to get yourself out of the hole. Is the difference between an individual and a government, especially the U.S. government, is that the government can simply borrow money basically infinitely?
Well, the government has the ability to print money. That's true. Should they do this indefinitely? No. But Keynes said, look, since the government has this ability, and it is actually one of the best times in history to borrow, you borrow low to create long-term capital investments in the economy, that's when it makes sense. It doesn't make sense to stop borrowing, to shut down this economic stimulus when you need it the most. So a lot of this is counterintuitive. The factions that cry about the debt don't realize that, once you have a vibrant economy, the debt gets paid off, and you have tax revenues coming in, and you don't have to issue as much debt, and you can gradually pay that down. So it's a short-term phenomenon. It shouldn't be long-term. The concern is that this long-term debt will be harmful, and it will be, but you can control it if you have some growth.
And the logic, or the logic behind this is simply that with a fair amount of growth based on this investment, the U.S. would be able to pay off. It's just such huge numbers. That's why I think people are a little bit surprised. The debt has grown, I don't know if it's exponentially, but certainly much faster than it ever did. And it just seems it's impossible to ever really grow enough in order to pay that off. But you're saying that that's just not accurate in terms of the math?
Well, in terms of what debt really is, in a lot of cases, it's the government owing itself money. The debt is bought by other countries. The debt is seen to be as secure. It doesn't pay very much, but it's still a store of value in some sense. So to completely denigrate the issuance of debt, I mean, the bond market pretty much runs, the raising of capital throughout the world. I mean, it's inescapable. It's been with us for a long time and will be around for a long time. It's not necessarily all that bad, and you should be getting into a little bit of debt when you need to provide that certain bit of kick that you need for the economy. So should it be managed long term? Absolutely. And I think if you do have a vibrant economy and people working and paying taxes, it's not so much of a problem. You really have to look at it as a percentage of GDP, and that's actually been falling in the United States. You look at Japan, and it's way out of control, but they didn't really have another way out of their financial crisis, and they're still kind of in some deep problems there.
All right. That's a very excellent summary. We've been talking with John Wasik, who has recently come out with a book called Keynes' Way to Wealth. You've also seen him on Reuters and all over the press. John, we're just about out of time, but in the last few seconds, tell us, how can people find more about you?
Well, they can go to my website, which is John Wasik, WASIK.net, altogether, John Wasik. Or you can go to any one of the book selling sites online. Just plug in the name of the book, Keynes' Way to Wealth, and you can find it at a good price. And it's full of a lot of different tips on how to build wealth over time. None of them are really crazy. They're just very solid ways of getting stocks with dividends and avoiding market timing and just some very fundamental things that have worked, for 100 years or so. So Keynes discovered this, and he put them to work, and he made a lot of money, and I think your listeners can do that as well.
Great. Okay, listen, we really appreciate that. We will put a link to this, to your site, as well as to the books at the show notes at goldsteinongelt.com. John Wasik, thanks so much for your time.
Thank you, Doug. Shalom.
You've been listening to the Goldstein on Gelt show with international investment expert Doug Goldstein. If you'd like your questions answered on the air or off, go to www.goldsteinongelt.com or write to Doug directly at doug@profile-financial.com.